Every business organization needs finance to start its functioning and for its survival. Under financial management, different financial decisions are taken by the financial managers, and sources of finances to execute such financial decisions are ascertained. Financial market is the link between the consumer and the business enterprises. Consumers invest their savings in the banks and financial institutions, which ultimately lend such funds to the business organizations at higher rate of interest and provide low rate of interest to the savers. Let us discuss financial market, functions and its types, money market and its instruments, capital market and its features, components of capital market, National Stock Exchange of India, Over-the-Counter Exchange of India, procedure of electronic stock exchange, benefits of online stock exchange, Depository Services, and Securities and Exchange Board of India. Financial market. Financial market is a link between the savers and borrowers. It transfers the money or capital from those who have surplus money to those who are in need of investment. It brings the borrowers and lenders together. It arranges the funds to the business sector with the help of capital market and money market. Functions of financial market. These are mobilizing and channelizing the savings into most productive use, facilitate price discovery, provides liquidity to financial assets, and reduce the cost of transaction. Types of financial market. Financial market is of two types: money market and capital market. Money market. Money market is a market for short-term funds meant for use for a period of up to 1 year. It is also known as near money. It is the source of finance for working capital. It includes call money, treasury bills, certificate of deposits, commercial paper, bank overdraft, cash credit, etc. Instruments of money market. These include call money, treasury bills, trade bills, commercial paper, and certificate of deposits. Capital market. It is a market which includes the organizations, institutions, and instruments that provide long-term and medium-term funds for a period more than 1 year to the industrial and commercial enterprises. Common instruments are shares, debentures, bonds, mutual funds, public deposits, etc. Features of capital market. These are link between savers and investment opportunities, deals in long-term investments, utilizes intermediaries, determinant of capital formation, and government rules and regulations. Difference between certificate of deposit and fixed deposit. Difference between capital market and money market. Components of capital market. Components of capital market are primary market and secondary market. Primary market is also known as new issue market. It facilitates the transfer of investable funds from savers to entrepreneurs. It goes directly to investors and utilizes their funds for investment in buildings, plants, machinery, etc. The common securities issued in primary market are equity shares, debentures, bonds, preference shares, and other innovative securities. The secondary market is the market for the sale and purchase of previously issued or second-hand securities. It gives a chance to investors to make profit. It encourages even those investors who wish to invest in securities for a small period of time. Methods of flotation of securities under primary market. The securities in the primary market can be issued in the following ways. Offer through prospectus. Offer for sale, companies to middlemen to public. Private placement, companies to middlemen to banks and financial institutions. Right issue, companies to existing shareholders. EIPOs, companies to public. Functions of secondary market. Liquidity and marketability of existing securities. Pricing of securities. Safety of dealing with transactions. Contributes to economic growth. Spreading of equity cult. Providing scope for speculation. Better allocation of capital. Promotes the habits of savings and investment. And economic barometer. Difference between primary market and secondary market. National Stock Exchange of India, NSEI. The National Stock Exchange, NSE, is India's leading stock exchange covering various cities and towns across the country. NSE was established in 1992, recognized in 1993, and started working in 1994. It is a corporate body. It was set up by leading financial institutions, banks, insurance companies, and other financial intermediates. Objectives of NSEI: establishing a nationwide trading facility for all types of securities, ensuring equal access to investors all over the country through an appropriate communication network, providing a fair, efficient, and transparent market for securities using electronic trading system, enabling shorter settlement cycle and book entry settlement, meeting international standards and benchmarks. Over-the-counter exchange of India, OTCEI. OTCEI may be defined as a place where buyers seek seller and vice versa, and then attempt to arrange terms and conditions for purchase or sale acceptable to both the parties. OTCEI has been promoted by UTI, ICICI, IDBI, IFCI, LIC, GIC, SBI, capital markets, etc. Features of OTCEI. It is the first screen-based nationwide stock exchange in India. First exchange to introduce market making in India. First exchange to introduce sponsorship of companies in India. Only exchange to allow listing of companies with paid up below 3 crore rupees. Only exchange to allow companies with less than 3-year track record to tap capital market. Has shifted trading from counter receipts to share certificates. Has introduced weekly settlement cycle. And allows short selling.
Bombay Stock Exchange, established in 1875. Bombay Stock Exchange Limited is the Asia's first stock exchange and one of India's leading exchange groups. Over the past 140 years, BSE has facilitated the growth of the Indian corporate sector by providing it an efficient capital raising platform. BSE provides an efficient and transparent market for trading in equity, debt instruments, derivatives, mutual funds, and ensures redressal of their grievances, whether against the companies or its own member brokers. More than 5,500 companies are listed on BSE, making it world's #1 exchange in terms of listed members. The companies listed on BSE Limited command a total market capitalization of US$ 1.64 trillion as of September 2015. It is also one of the world's leading exchanges, third largest in December 2012, for index options trading.
BSE is the first exchange in India and second in the world to obtain an ISO 9001-2000 certifications and receive Information Security Management System Standard BS 7799-2002 certification for its online trading system, BOLT. It operates one of the most respected capital market educational institutes in the country, the BSE Institute Limited. BSE also provides depository services through its Central Depository Services Limited CDSL arm.
Advantages of OTCEI. It provides trading platform to smaller and less liquid companies which cannot be listed in regular stock exchanges. The cost of issuing securities in OTC is quite low for issuing new securities and lower expenses of servicing the investors. It provides transparency in dealings with no problem of bad and short deliveries. Dealers of OTC can deal with the primary as well as secondary market. It facilitates free flow of information from customers to suppliers due to online information.
Steps in the trading and settlement procedure. First, approach registered broker. An investor intended to buy or sell securities has first to approach a broker duly registered with SEBI and to sign broker-client agreement by providing necessary details. After the agreement form is filled, broker opens trading or demat account in name of the investor. Second, opening demat and bank account. As the broker-client agreement form is signed by the investor, the broker opens a demat, that is, dematerialized account, in name of the investor. Third, placing order. After the opening of a demat account, investor can place an order to his broker to buy or sell certain securities with a clear instruction regarding number of securities and the range of price at which the securities have to be bought or sold. Fourth, execution of the order. As the order is placed, the broker will connect his server to the server of main stock exchange to match the share and best price available. When the desired shares with the desired price can be bought or sold, it is communicated to the broker's terminal and deal is struck automatically. After that, broker issues a trade confirmation slip to the investor. Fifth, issuance of contract note. A contract note with unique order code number assigned by a stock exchange is delivered by the broker to the investor, which contains the detail relating to the number of securities bought or sold, the price, day and date of deal along with the broker's commission. Sixth, process of settlement. Under rolling settlement, all open positions at the end of the day mandatorily result in payment or delivery n days later. Currently, trades in rolling settlement are settled on T+2 basis, where T is the trade day. The settlement cycle has been reduced from T+3 rolling settlement to T+2 with effect from April 1, 2003. A. Pay-in day is the day when the investor has to deliver the shares he intends to sell or pay cash for the securities he intends to buy to the broker, immediately after the contract note is issued, which should be done a day before the broker delivers the shares or pay cash to the stock exchange. B. Payout day is the day when the exchange will deliver the shares or make payment to the other broker. The broker at the other end will have to make payment to the investor within 24 hours of the payout day since he has already received the payment from the exchange.
Benefits of online stock exchange. These include demutualization, dematerialization, and rematerialization. Depository Services. Depository is an organization which holds shares, debentures, government securities, mutual funds units, etc. in electronic form at the request of the investors with the help of depository participant registered with SEBI. At present, there are two depositories registered with SEBI: National Securities Depository Limited and Central Depository Services Limited. Services of depositories. These are elimination of risk of loss of securities, elimination of bad deliveries, instant transfer of securities, fast settlement cycles, waiver of stamp duty, and convenience in change of address and transmission. Difference between bank and depository participant. Securities and Exchange Board of India. SEBI was set up on April 12, 1988 under the control of Ministry of Finance of the Government of India. It regulates the functions of securities market. SEBI promotes orderly and healthy environment in the stock market. On June 30, 1992, SEBI was granted legal status through an ordinance by the Act of Parliament. It is a corporate body having a separate legal existence and perpetual succession. Services of SEBI to various groups. It was set up to meet the needs of the following three groups: issuers, investors, intermediaries. Objectives of SEBI: regulate stock exchange, protect and guide the investors, prevent trading malpractices, and develop code of conduct. Functions of SEBI. Following are the three most important functions of SEBI: protective functions, developmental functions, and regulatory functions. Protective functions. As a protector, SEBI checks on price rigging, prohibits insider trading, SEBI prohibits fraudulent and unfair trade practices, educate investors, and code of conduct. Developmental functions. SEBI promotes training of intermediaries, internet trading, makes underwriting optional, started issuing of new securities. Regulatory functions. SEBI has framed rules and regulations to regulate the intermediaries. Private placement has been made more restrictive. Registers and regulates the working of stock brokers. Registers and regulates the working of mutual funds, etc. Regulates takeover of the companies. And conducts inquiries and audit of stock exchanges.